Oh, hi, Simon. Welcome to Venture with Grace. We're live.
Great. Good morning, Grace. Thank you for
Good
having me.
morning. Oh, so let's start off. I want to let the audience to get to know you a little bit more. So you started in investment banking after college, and then you have worked on the corp dev team at VMware, and then later on, I feel like now you're at a partner at Cathay. Why don't we start with like what were some core lessons that you've learned early on that you kind of took into running your day to day as a partner at Cathay Innovation?
I appreciate that, and it's so nice for you to have me here. Yeah, I think if I take a step back and look at my journey, I think everyone says there's no straight line into venture, and I would say even though looking at my resume, we just mentioned of my
Mhm.
past, it sounds a little straightforward, but I think there were some loose points I kind of connected the dots across the board. In college at Berkeley, I was both a business and engineering major, and I thought I love tech, want to be at the forefront of tech. But very quickly realized there were a lot more smarter people at me in Berkeley that were doing that, and so I switched to more of the finance side because the numbers spoke to me a little bit more. Investment banking for me was a stepping stone, especially in tech M&A out here in San Francisco, just to really understand all the big companies, what they were doing, as well as some of the smaller companies that were raising a lot, and just kind of how to kind of those worlds kind of work together. Um, you know, that in itself, M&A itself was kind of a stepping stone. When I went to VMware, VMware was an extremely acquisitive company at the time. This was during Pat Gelsinger days, and they were averaging about 6 to 10 acquisitions a year. It was really a machine, kind of like Cisco was. And so having that volume and just being at a place where they were constantly innovating so many different divisions and thinking about bringing talent in, either buying a technology tuck in or a product kind of addition to the roadmap, or actually bringing real revenue and business lines like AirWatch, one of the $1.5 billion acquisition they did at the time. It was a really nice front row experience to see how companies really thought of bringing external innovation inside of a large company. And I think that's really important because I think Cathay Innovation as a global platform, I'm thinking about that with a number of corporates as LPs in our fund, really kind of resonated and helped connect the dots in the two. I think I left right when kind of the Dell and a number of kind of things were happening at VMware. Um, Cathay Innovation kind of started as a global firm headquartered out in Paris, part of a larger asset management group called Cathay Capital. The venture side, or Cathay Innovation, was started on this notion of being able to help founders globally be able to invest in a number of core themes that they care about: fintech, digital healthcare, consumer commerce. And so one of the things that help us kind of our value add, if you will, or what differentiates us, is having these corporate LPs in the fund that are helping us both on thesis building, thinking about what they care about because they're leaders of their firm. These are brands like household brands, right? Unilever, L'Oreal, Michelin, to Sanofi in healthcare, to Vallejo in automotive, and BNP Paribas in banking. They are actually the ones that are consuming a lot of this technology, or at least observing kind of the problems given they're doing that. And so being at VMware, having that kind of understanding of investing off balance sheet and trying to understand the mindset of the founder, we saw there was kind of that 1+1 = 3, but felt having a CVC, or at least investing off of a company, just wasn't the same when it wasn't a separate entity. And so that was like a huge lesson where I think we saw the merits and value of having a large company, invest, kind of help. I want to legitimize the tech is probably not the right word, but I think give it a lot of more, emphasis, if you will, in making sure that someone's willing to partner with you this early on in the stage of a company, where I think some of these doors can really inflect and change the trajectory of some of these companies. And I think, secondly, I think helping founders really understand we all talk about these M&As that are supposed to happen this last year, this year, next year, and now with this new administration coming in, maybe it'll be a little more lax. But what is, how do you get a deal done, and how do you find a home, and what would really stand out, right? I would never tell a founder this is how you build to get acquired per se, but I think those that have been bought before just know that there's a bit of a factory line in type of a model in which people know what they're looking for, and that helps kind of think through that. And so having 20 corporates now as LPs in our fund, we've been able to kind of work very closely with them on a quarterly basis to hear and think through what they're thinking about, but also share what we're seeing on the front lines of innovation to do that. And I think without working at a large company before, to actually kind of experience how that interaction can be really valuable, it's hard to kind of really put that in position that outside of just saying, hey, I have a Rolodex of founder. I think that's the big difference. As when people say, hey, do you go deep? We have an ecosystem team. We have kind of a quote unquote playbook, if you will, to try to do that. Obviously, I think results are depending on the founder and what gets done. And so it's hard to say I can promise you X, Y, and Z, but I think at least setting them up and letting the founder kind of take the baton after a very, very warm intro is helpful in doing that. So yeah, I'll pause there and happy to take it in any direction.
Totally. I was like taking some notes. So like I wonder, so like one of the core lessons you've learned is like through VMware. So like they have clients in a lot of like different traditional corporations. And I wonder how does like, for example, like how does a software sell to a company actual happen? So like for example, let's say if you guys are working with a traditional company, like can you talk about like how do startups or even like any tech company to sell to their CIO? How is the process kind of works, or like do you have to have the CIO mention like 40 current solution they're using, trying to find equivalent? Or
Yeah.
yeah, we'd love to like learn a little bit more on that end.
Absolutely. I think there's the notion that you started off as bought, right? I think there's a
Mhm,
difference between bought and sold,
mhm,
especially when you're selling, if you're going to be acquired or if you're kind of running a process with a banker and trying to
mhm,
sell your company. And so oftentimes, especially right now when founders in the ecosystem are thinking about, hey, maybe I need to land the plane somehow. I think the things that come up the most is working backwards on what that success looks like, and understanding
mhm,
who are the stakeholders that need to appreciate you in order to drive that. I think the first and foremost, it always starts with some sort of partnership. If you are, running a process already, a banker's introducing you for the first time to the GM, that's going to be where you're landing the
mhm,
plane in. That's probably not a good recipe to start in doing that. What I've seen the most success for founders, and this is different because I think oftentimes people think, regardless of their size, there's a home for them. One of the things I observed was really kind of two ends of the spectrum. I think there's one end, which is the sub 200 million type of acquisition that,
mhm,
regardless of kind of how, I mean, there's still a certain amount of, I think, size and scale the buyer needs to be. But I think knowing that you are bringing a technology and team and to be bought and to be tucked into their kind of roadmap is kind of a positioning on one piece of it. And the
mhm,
other end is like really thinking about being a standard product line they could build on. So this is 200 plus million in size they have to be in order to be interesting for a company that's already doing billions of revenue, right?
mhm,
Because you're expecting, to spend at least, call it, they do $1 billion in revenue, you're at 10x multiples, or you're at least, 10 billion plus, and you want $1 billion plus acquisition because you're at 200, you'd love to sell for more than 5 times. That in itself means that someone's going to spend 10% of their market cap to buy you. And so that's really important to really think about. How you're going to be special to them and be able for them to kind of turbocharge that aspect of it. Where you're kind of in the middle, where you're like, call it 25 to 100 plus million revenue. That's like
mhm,
a little bit of like no man's land. And,
mhm,
and so what I've noticed there is just you're not big enough yet to be like truly standalone that won't get consumed in the machine, and you just aren't ready yet to stand alone by itself because maybe you need a second product or something like that, or you're not small enough that the price would make sense for you because obviously you wouldn't, if you've already been 25, 50 million in revenue, I'm sure you're not trying to sell yourself for a couple 100 million at that point. And so kind of this like in the middle makes it really hard to get something done. And so I think, to answer your question, it really comes back to what place you want to be in, and are you can demonstrate that with what you have built. And really comes down to the partnership of starting to know that GM early on, have a couple common customers, being able to stand out that especially you're a revenue driver for them, or you're helping them from churning big customers. I think some of my founders recently had a conversation, was just like, yeah, I brought in this new XYZ huge large account that you guys had never been able to crack. Now they're asking about which tech do I use, and I mentioned you guys, and now I found the account manager, and we're going to create a joint deal together. And then coupled with that, so and so was going to switch off to your biggest competitor, but because we were in there, we were able to save it, and now we're actually increasing it because of what our technology does, right? That in itself is a very nice story. You can tie that up in a ribbon. No GM is going to say no to you in doing that. And so I think that's like a great example to kind of help answer kind of your question.
Totally. I feel like I really like what you said about like, technology is bought, not sold. So you supposed to identify, like, I guess like the company have to identify you as like a core value proposition. And then there's like, three different sizes of company that like could be, like reviewed by like different light within the company. And since like, we talked about like the tech merger side or like, the acquisition side, maybe we could talk a little bit about like the IPO market.
Yeah.
So, you have a prediction that like I mean, I will let you finish the prediction. So maybe we could talk about the prediction for the IPO market in 2025.
Yeah, I think I have my feeling is that there's going to be a lot of IPOs in 2025, more so than the last few years. But I think it'll be actually not as much as we all think. Like like
Mhm.
hundreds of companies, right? I mean, I think there's a lot of stats out there that talks about the hundreds, if not thousands, of unicorns that may be potentially going out. But I think maybe within that, let's probably call it, you know, probably less than 300 of those are really quote unquote IPOable from a scale perspective, and where everyone's like, hey, next year's that big opening. Now that you just saw Service Titan go out and there's so much demand, maybe there's a lot more other people that are doing that. And I think there will be some, but I don't know if everyone is actually able to grow and have the right metrics to go public in doing that. What that means is like maybe it's going to be like, call it, I don't know, a tenth of that, so 30, 40, maybe something like that next year. Because I think it's a couple folds why people may go public and may not, right? I think there's an incentives question. I think only certain companies have the incentives to go do it. I think there is a strong liquidity in the secondary market. Thrive Capital has created this amazing new product out that they're investing in the best seven private, companies, just like the Magnificent Seven, the SpaceX, the Databricks of the world, et cetera. There's so many secondary or tender offers to help solve the employee liquidity issue or early investors, et cetera. And so they're all at attractive valuations, right?
Mhm.
And so it allows for people to stay private longer. And so it changes the incentives a little bit more. And I think, you know, um, that allows for, I think, like mutual funds and some long only funds be able to have access to some of these like tier one names that people were hoping would go public next year to do it a la Canva, Stripe, SpaceX, et cetera, right? On the other hand, I think there is then even if you do that, doesn't mean that you don't go public, but it is just now the rush to do it may change, and so people may decide differently what they want to do and doing that. On the other hand, I think there's a lot of companies where they see where their metrics are that finally now have this window, but maybe not feel like the valuation that they will get because of where they're tracking from a company portfolio perspective may not be the level that they hope for, right? And so they might have the big bang that they were hoping for from day one, or not want to take that big down round valuation. And so I think there's a lot of companies that may wait till actually 2026 to do that. And so in between that, there's this world where you have this reckoning where everyone's going to look for some more practical kind of outcomes, right? These board members invested in 2021, gave these large prices, lots of cash, and some of them may have a lot of cash, some of them may be running out now. And so there may be some practical outcomes in terms of like, maybe let's look at dual process, maybe let's try to sell ourselves or do an IPO for 2026, and do that as well. And so I think the delayed plans may be the case. And so,
Mhm.
you know, kind of going back to our early conversation of being bought versus sold, I think this is where some of those conversations may play out. That maybe it's let's see if there is an interesting home and we realize value that way as well. But in any case, I think if you have this really nice push of people going public the first couple months or couple quarters of the year, and then afterwards probably there might be a little bit of a pause as everyone digests all of that. But that allows, maybe that's actually the point where there's actually more M&A as well too at the time.
Totally. I wonder, so like, what's your thought on like people doing a lot of these like SPVs for SpaceX? Like, do you feel like what's the motivation of like being like, I guess like beside like the money making side, but like I guess like what's people's mentality of like purchasing these like or like investing in these like SpaceX SPVs? Like, do you think it will actually make money for people? Or like I feel like there's just obviously a significant amount of hype in the valley about these like really you mentioned like the Magnificent Seven company. And and I wonder like, how do you evaluate these like deals that comes to you with like the different opportunities investing in? Since like I mean we're not like a financial advisor podcast or like this is like not financial advice, it's more of like learning about people's like psychology and insights from experts. But anyway, so yeah, would love
Yeah,
to hear your thoughts
I
on
think, these very coveted names or companies
that.
that everyone think are extremely, well, there's just so much demand more than supply. And so I think like names like SpaceX and Databricks are just extremely liquid. And so people can trade them just almost like stocks, you just kind of know where to get them. And unfortunately, because they're not public, then there's a liquidity premium or some additional
Mhm,
fees that you have to pay through these kind of SPVs in order to access it. So you're just paying for access and in doing that.
mhm,
Everyone, obviously wants to be able to get in earlier, hoping for that big pop on day one or later on in doing that. And so I think, people feel that this is a better opportunity and some of the names in the that currently are public right now, or maybe
mhm,
they just want some exposure to like space or the next generation kind of data storage or things like that,
mhm,
right? I think that's just is you just want to own the best companies out there in the world, and who knows when they go public, but at least
mhm,
this way you can get into them, quote unquote, earlier, if you will.
mm. I wanna maybe like we can dive into a little bit more about like the mid-tier tech mergers. So
Yeah.
the companies that are making 25 million to 100 million revenue. Um, like, can you define what is a Frankenstein merger and how do they kind of like work for everybody?
Yeah, I think we were joking about this a little bit earlier, but I think I was outlining a little bit earlier about kind of so I invest here usually in Series A and B at Cathay,
Mhm,
which have a product, couple customers, and a business model. So
mhm,
oftentimes, they're kind of at that inflection point, but
mhm,
at some points they may inflect and you may hit a wall, right? Which is pretty
mhm,
common because you can't build your second product, or just the market's maybe not as deep as you thought it was, or
mhm,
you know there's another competitor, et cetera, right? I think
mhm,
as we've seen, there's like six companies in any one given category right now,
mhm,
from AI scribes
mhm,
to AI based SDRs and
mhm,
sales tech and et cetera. Not everyone's going to be able to make it, and so what happens is there's a bit of consolidation that has to happen in the
mhm,
category. And so, in 2021, when all these companies raised that really large valuations or raised just a lot of money in general, they're going to be faced with kind of this, if you're into two bookends, right? You're not 200 plus, there's a clear IPO track for you, or you're not small enough that it's a very easy tuck in that, being sold for 300 million isn't a bad thing from an outcome perspective.
mhm,
You're going to have to kind of figure out where to be in that middle, right? Oftentimes, you're kind of growing, maybe you're not, you were trying to cut your burn down, and so you can control your destiny. So maybe your cash will break even, but you used to grow at 30%, and now you grow 10% at best, right? Because you essentially cut off a lot of the investment to do that in order to kind of control your destiny. Years of doing that, or maybe stagnant growth, just forces you to say, hey, like, as a board member, and just, people have times that they have to return money to their company, and, you signed up to join a mission to build a rocket ship, and maybe the rocket ship isn't there. You thought you can land the plane in a very obvious kind of what we talked about earlier in a home at a company, but maybe there's just not a home for you because you're just a little too small, or maybe even private equity is not interested because you're again also too small, just like kind of we talked about even for that size. And so I think there's a world in which, because of also I think valuation, because these companies have really high marks and want to keep that, or just don't want to face the music just yet in that reset. A lot of them can combine with each other and sort of create this private on private acquisition. And I'm sure there's private equity or credit funds, et cetera, that want to kind of make it for these combined entities to kind of be more efficient, stabilize, scale, and then maybe eventually get to the point of that 200 plus more, which then can lead you to, potentially an IPO or an M&A situation out there. I think a lot of it came down to, I think, pricing at the end of the day. People just have expectations because they raise so much money, or what is acceptable to them to move on from their current situation.
Totally. So I wonder, so like, I guess like you mentioned about like the AI scripts, or like the AI SDRs, or like, these like specific, I guess, like vertical AI agent sector. Maybe it's like a good sector to look at. But like, I guess, like, how do you pick who do you merge with? Or like, do you just merge with like your direct competitor? Let's say like, Odex and Elance merge become Upwork, or like what's the kind of vibe there? And then like typically, how do these conversations even happen? So like, is that like, one CEO just meet another CEO, be like, hey, I think we're both dying, maybe we should merge.
Yeah.
But if like everybody's dying, like why would they even merge? Because that's just like fail even faster. But how do you think about these like um I guess like Frankenstein MIAs?
Yeah, I think it's a little bit, I think, very specific to the category of each of these founders, right? I think
Mhm,
some of them have much more easier homes. A la, if you sell to what Microsoft is already selling to a bunch of people, it's a little more obvious that you kind of
mhm,
partner with one of the companies that, maybe Microsoft not the perfect example, but let's say like in sales tech or marketing tech, you just don't need 6 versions of the same thing. So you can
mhm,
consolidate and kind of, combine customers, or maybe like one is focused on the enterprise, one's focused on the mid market. And so it makes sense to kind of create a joint motion in doing that. I think oftentimes you've also seen, especially in the data world, people just picking different pieces of the value chain and combining it into a joint solution. That happens oftentimes in security, happens sometimes in data. It's just the buyers are the same people. Instead of picking these point solutions are best of breed, let's combine it together into making it a broader platform and doing that, right? And so
mhm,
you're kind of now combining a bunch of 20, $25 million size companies, and pulling it together, and hopefully you can and build that. But it also, I mean, at the end of the day, a merger is just like a wedding or a marriage, right? It is really much a people focus at the end of the day, and the easiest way to shortcut this is always to have a CEO to CEO conversation to see if there is that appetite, and you'll know from there, right? Some
mhm,
people also want to just land the plane too, and so maybe it is just good way to take care of the team and the tech and everything they've built, and go focus on a new shiny object because they're just forever serial entrepreneurs.
mm, totally. Okay, so I wonder, since we just talk about like, companies don't need like 6 version of like the same marketing software. Like AI will have a reality check. So I wonder, so like what's your prediction on like, how will companies kind of like, what are the companies that will survive in the next few years versus like what kind of company that will the evaluation dies down, or like how do you think about the AI market in general?
Yeah, I think I would separate those two as the AI haves and have nots. I think there's
Mhm,
3 sets of companies today that are, you'd say AI native, companies to, on the other end, being kind of AI enabled, which I think everybody else is. There's
Mhm.
people that are building in between. That's kind of sort of like I would call it a kind of a more co-pilot-ish type model. In that world, you don't know if that's a kind of stepping stone or if that's actually the best way for do things. And doing that. So I would kind of categorize those across the board. I think those that survive or not survive is part of hard to say, because I think one of the beautiful things about AI the last since ChatGPT kind of took everybody by surprise, if you will, or at least the consumer market by surprise, was you're in this honeymoon phase. Every single week you find something new. The pace of innovation is
Mhm.
just through the roof, and it's just super exciting to do that, right? And so because of
Mhm.
that, there's always quote unquote either you're gonna it's a feels like a marathon. It's supposed to be a marathon, but it feels like a sprint because
Mhm.
every single week you got to catch up. And the other hand, you have this world where this excitement kind of runs out because you paint this great vision, but the buyers of your technology, at the end of the day, you have to take that vision and build it in a great business.
Mhm.
Doing that that goalpost continues to shift every single day because your buyers are just inundated by new ideas every single time. And so how do you take that hype to kind of really reality, and to your point about surviving is the case, right? And we've seen, some early ones, the Jaspers of the world, like, that had this huge thing, excitement. Then, was, Microsoft or some incumbents come out with some features that ended up as part of that, create this huge competition. And then, now they kind of, kind of pivoted a little bit and now figure it out and are humming just perfectly fine, right? And so I think a lot of it is that you can kind of be able to sprint, raise a lot of money, and then kind of have an amazing team that just kind of tinkers their way through it, just because the innovation pace is so fast, and sometimes the incumbents just can't catch up in doing that, or you just have smart people and the runway to be able to find your next white space to do that. And so I wouldn't say I have a crystal ball and say which of the three different kind of setups of companies wouldn't make it. I think at the end of the day, you look at consumer needs and wants. I heard this at a different podcast. It was like the billionaires test. It's just like, billion has all these services that are due them because they pay for it, right? Someone to, schedule for them, someone do all these services for them, all those things an average consumer would love to have. And so with technology, and you can democratize access to that and get it to a price point that makes sense, it's always going to be something that people need, right? I think the consumer needs haven't changed. I think the delivery platform, or just quote unquote AI, just tech now, is probably the same. And so I wouldn't, you just come back to having to build a great business that people like really appreciate.
Totally. The it is like very close to the last prediction, which is like the SaaS evolution. So maybe we could start with a little bit about like, what were some major trends in the past few years, and then, since you mentioned like AI integration, will like more. I guess like AI will be more integrated into the traditional SaaS.
Yep.
Maybe we could start with like what is a traditional SaaS versus like AI integrated traditional SaaS.
Yeah, I think you know, uh, I think there are solutions that sell to enterprises and solutions that sell to like SMBs, right?
Mhm.
And when you think about the buyer and sophistication behind that, I think there's two different ways to look at it. I think the reality in enterprise right now is that there's a lot of trying, there's a lot of testing, there is a lot of usage internally. As I talk about, kind of everyone's using some form of AI to turbocharge their
Mhm.
productivity, but that excitement in terms of like understanding what adoption and truly building kind of a long-term defensible, scalable business model is still TBD. And so, there's these grounds for experimentation, but I think the question is like, are you replacing labor, right? There's this whole
Mhm.
concept of, service sold as software now, because, instead of having a team, and for like customer support, for example, I think very commonly people outsource that into other countries to outsource labor at a better price point. But if you can train technology to be able to do that, maybe tech is pricing it similarly as a replacement of labor to do that, or at least an augmentation to kind of solving kind of what you need in doing that. But that's going to take time in terms of getting the data. Like the same problem we had in big data and et cetera. My data's messy. It's all siloed. How do I get it in a place so that I can train and be able to build this new agent to solve customer support or sales, for example, is pretty darn hard. But I think for SMBs, I think it's a little bit different that you and I, as entrepreneurs and starting a business, we don't have the time to have a CIO to go and tell me what's best of breed, build me the right stack. Just tell me you can take my phone call for me, right? I can't afford hiring an EA, so just have someone schedule the call for me. Or if I'm on Yelp and I'm a plumber, and if I miss that phone call, they're probably gonna go someone else. I'll miss that sale, right? And so I just need a solution and I need results, right? Like especially in the economy right now, while even the stock market is so strong, I think we've seen across our portfolio that SMB recovery is a little bit uneven depending on the industry or a category. And so because of that, I think the notion of adoption of AI actually would be a lot faster there. What that means is that I think those AI or SaaS software that existed the last 10 plus years, which was really about kind of taking your technology, organize it, making it in a very streamlined way to be able to use it. A lot of these databases or CRMs or your workflow tools, those are, that has to integrate with some of this AI to create a much more bundled solution, right? Either you're selling it as a service to replace a customer service agent, or if you're trying to just even have a lead and compete with some of the incumbents, right? Salesforce has joked that they're going to sell a bunch of AI agents, but they're going to hire a bunch of salespeople to sell those AI agents, which is kind of hilarious when you think about it. But at the same time, it is AI today is replacing both software and labor costs with a new solution. And so when you think about that, you have this whole data. How do you kind of add, voice or something like that to be able to leverage it to create something that meets the customer's needs, as opposed to saying I was a best of breed point solution in solving that. That in itself can be done either by a startup or done by an incumbent. You would think that the incumbents, because they have all that data, they can move fast enough to add some of these open source technologies or even partner with some of the middleware out there to offer that. Can you create something that I think at the end of the day, we're kind of moving that point from, hey, the mobile phone's hot. Now I'm looking for the Uber Airbnb app. What's that new solution that everyone's gonna be super excited about, right? There's early signs that customer support or healthcare kind of use cases have been kind of the early adopters in doing that. And so that's really the kind of where I think the integration needs to happen to make the intelligence really work at the end of the day.
Totally. I like what you said about there is actually two side of the businesses. So like one side is like people selling to enterprise, one side is like people selling to SMBs. Like, there's like different level of like risk tolerance and like budget for either of these categories. And maybe we could talk about like since like you guys are investing in all different kind of like softwares and like just like companies in all different sectors. Maybe we could start with like you're almost 9 years at Cathay Innovation. So you were their first hire here and like gave us like the quick rundown of like the different, I guess, like stages of the journey that you have been through, and then like the cycles that you have seen through, as well as like maybe also like generally, how did you see your fund's investing strategy evolve in this like 9 years?
Yeah, absolutely. I think venture has as an asset class, as you know, has just completely changed, I think, multiple times across the board. And
Mhm,
obviously now we're in this new super cycle of AI. And so the
mhm,
exuberance and interest is higher than ever before. Bubble or not bubble, we'll let others that are smarter than me debate that. But I think I really appreciate you highlighting kind of the journey. It is when you take a step back, it's been almost a decade in
mhm,
helping build. Cathay Innovation will be 10 years old next year, and so it's really exciting time to kind of take a look back and see what we've done. But I think I think the journey is still beginning. I think venture continues to reinvent itself, and so we have to quote unquote solve for that product market
mhm,
fit for our customers. But just taking a step back, I think we started. So I met Denny and Ming Po, kind of the co-founders of Cathay Innovation in 2016. And so at that point, Fund One was roughly about 287 million euros. We're a European fund headquartered out in Paris, and so
Mhm.
we're kind of regulated by the French markets, and so our funds are on in euros. Call it about 320 USD at the time. We were very fortunate to be part of some really category game-changing companies. So we were early investors in Pinduoduo, which obviously
Mhm.
had fastest to 30 billion in GMV and was over hundreds of billions in market cap. Today, we were early into Chime, which is a neobank here in the U.S. As well. These are kind of these ideas, like companies that we were able to learn from each other from each of the different geographies. And so, just using Chime for an instance, um, you know, Denny had, one of our LPs is BNP Paribas. They had just acquired a neobank at the time, very earlier on. And one of the things that we've learned and saw in Europe that was happening was that the next generation was really interested in a digital only bank, right? I think the
Mhm.
notion at that time in 2015, 2016 was, will customers, go away from their branches and be comfortable with doing all their finances online? And so
Mhm.
seeing that, having a team, a third of our team out in Europe, be able to understand that trend was already happening, and obviously in
Mhm.
Asia where we had a team too, that clearly happened, right, with WeChat and Alipay, etc. Why can't it happen in the US, right? And so this is the kind of the business model we've built at Cathay, which is to learn and have kind of and see from what our team is doing in each different regions, because we really think technology innovation across the four core areas we spend time: fintech, digital healthcare, consumer commerce, energy mobility, is really just being adopted in different paces. And so if we can see kind of what's working and kind of anticipate that, maybe we can find that trend elsewhere in doing that. And so that kind of got us comfortable in working with Chris and Ryan, founders of Chime. And so that kind of led us to actually be able to invest in something like that. But that's kind of the platform thesis and the idea and what we were trying to do
Mhm.
with the 300 million fund, which is predominantly, I would say, focused, probably back then a little bit more Series Bs, when there was a lot of funds in the venture world that were kind of seed funds and A funds. And that's kind of their extension was, hey, I can own 20% of the company at a certain price, and my fund set up for that strategy. And that's the case. And then there was a bunch of funds that were, you know, focused on the growth round. So it has to be a certain size, scale for me interesting. So there's like this messy middle world, as you
Mhm.
know, that wasn't, that everyone said it was either too early for them or too late, depending on which
Mhm.
you met. Great answers, I know, the founders, because like they're like, I thought I built a great company, but I didn't take into account your fund strategy, right? And so that the notion of fully multi-stage in the sense of like I do everything wasn't as popular then. And so that's how we kind of couple the fact that we had all these corporates that were interested in working with earlier stage company. This is that point of that inflection point where you have a product, couple customers, and that business model allows you to kind of work with that. So that was kind
Mhm.
of fund one, and the fund one strategy that worked out. We got extremely lucky. There's a number of other companies that are still left to go public that will be coming in the coming years, hopefully. And so that's the fund two, which is a 650 million euro verticals. That led into then our latest fund three, that was at the end of 2022 that we just launched, which is a new $1 billion vehicle in doing that. And so, over years, we've gone from zero to over 2.5 billion in AUM kind of managed for us in that short amount of time. And so trying to be a unicorn like the founders that we back in doing that.
Mhm.
And so that value prop though has kind of stayed the same, I think, because the venture market, as we were kind of going back to your question, has now bifurcated a bunch of multi-stage managers, extremely large, and keep out like adding more assets over and over because they're kind of fee managers now, similar kind of in the private equity world. But then there's a bunch of specialists, a lot of
Mhm.
sector funds, like our friends in fintech that have. There's a number of funds that are dedicated fintech funds, or now there's dedicated healthcare fund. There have always been dedicated healthcare funds, but I think there's more and more of that as they kind of take advantage of that opportunity. or consumer funds now that have kind of also evolved a little bit in the B2B, but they've kind of picked their specialists, if you will, in doing that. Obviously, now there's also a ton of solo GPs that anyone and everyone is starting a fund, even though fundraising's hard, and doing that. And so I don't know if that has really changed that much over the last 10 plus years, but I think the notion to see a lot of our friends have graduated into doing that is really exciting, and doing that. But it's that has changed the incentives of where people want to spend their time. And so our value prop of focusing on A and Bs and having potentially an ecosystem to help them with and bring a different set of customers that that have already worked with our favorite top 10 funds, is still, I think, a value proposition that resonates with founders here in the US, on that side. And so I think that answers your question, but I'm happy to take it in any direction if I missed anything.
Totally. I wonder, so since like you guys are a multi-stage fund and then like you guys invest in like various different sectors, how do you I guess like spend your time to go deep on each different subsectors? Or like would you say, let's say you encounter a certain company that hits like a specific like financial metrics, and then you go deep into that specific sector, see, the competitive landscape, or like how do you think about like from like a time spending perspective, like how do you effectively you know spend the right time on the right things?
Yeah, I think it's a great point because even though we look at a lot of things, I think there's two things that should still stay core because we can't cover everything. There's just not enough people at the
Mhm,
end of the day. And there's not enough large outcomes, frankly. If you look at kind of the number of things that invested in vertical software and
mhm,
those that haven't created, the service side was a great example where a lot of people thought the TAM was too small and then didn't believe in them. And here we are, we have this large, very large outcome doing that. But to answer your question, I think we do only four areas. They're really large areas, but we
mhm,
only do four: fintech, digital healthcare, consumer commerce, and energy mobility. And doing that, people have dedicated funds though in solving for that. We felt actually what we're seeing is this intersection where, and we see this actually with our corporate LPs too, is that what's happening. Think of like the autonomous driving, for example, right? There was all these years of pushing autonomous technology. Now there's cars are actually offering insurance if the autonomous car
mhm,
gets in an accident. Who you have to solve that? How do you think about the financing of it? Because the pricing has continued gone up as you've seen, kind of electric cars are a very different price point than gas cars, right?
mhm,
And so there's a fintech component to something that was a very mobility, and there's also an energy component to it too, right? And so you kind of have these different intersections of these
mhm,
industries that can learn from each other, right? The insurance or financing to actually energy costs and maintaining that to actually building up the technology. All
mhm,
these things are no longer, I would say, as siloed as we thought it was
mhm,
before. And so you actually kind of need expertise across the board to be able to do that. I think our team, we segment a lot in verticalization just to make
mhm,
sure, we're thinking about the value chain very appropriately, very on top of the connections and relationships needed that our founders are looking for. And it takes someone to spend that time to do it.
mhm,
But I think you take a step back, a lot of our deals, is really kind of a cross pollination between the two because we have teams from other geographies or other sectors kind of work tandem because it's just learning, right? Healthcare right now, there's a big problem of affordability, right? That's really a financial services problem.
mhm,
There's a number of other things to solve affordability, but I think that's one way of thinking about kind of how that intersects, right?
mhm,
Financing a battery, for example, right? That's been, the cost of batteries are really expensive. And so, is it an engineering team that's really good at solving the next chemistry of the battery? Or is it how do you get
mhm,
it to the hands of consumers in an affordable way? And what's the right mechanisms to solve that, right? Those are all kind of things where there's a lot of kind of intersection across the board. And, there's a lot of, I think business models are innovating too, like pharma trying to get closer to the customers now and actually have, D2C or something like that.
mhm,
So things are, I think there's a intersection across the board. And so
mhm,
the industries are learning from each other. And so they're not as clear cut as they are before, which I think is a benefit to allow us as more of a generalist kind of take to it, be able to step back and be able to just look outside of the metrics and really understand the vision and thesis a little more and appreciate what the founders are trying to do.
For sure. I totally agree with you on like there's like a lot of intersection between the SAP sectors, whether it's like finance or healthcare or like anything that's kind of like all intertwined. I maybe we could start with like talking about, what do you look for in Series A and Series B type of companies, and maybe we could use some of your portfolio companies, let's say Chime or Ghost, like how do you kind of like encounter the company, and how do you evaluate them, and make the investment.
Yeah, absolutely. And I'm sure you've asked this question to a number of our friends in the industry because I think that answer
Mhm,
evolves a little bit by people. But I think, and we get asked as founders every time because they're like, hey, is it the Series A 1 million now? Is the bar to get raise a Series A 3 million? Like,
mhm,
it seems like you guys keep changing the goalposts and you just keep
mhm,
telling me it's too early. What's the answer, right?
mhm,
And unfortunately, you probably gotten many different answers, and my answer will probably be slightly different than the last person you asked, and it'll be different than the next person you ask. But the way we see what a Series A kind of ready company is kind of really de-risking the fact that you have product market fit. And that means having a couple people willing interest to buy your product at a similar price point in a single time. Because we are trying to evaluate not just the merits of what you've built in terms of, hey, do
mhm,
people really care about this pain point, but can we find a market that's deep enough that will buy it in a similar fashion? Because I think going from that A to B and building that engine of repeatability, do we
mhm,
see that the early signs of that, and we understand that the industry is deep enough to support that to build
mhm,
a very large outcome. Now, I think lettering what an A, a B is, and what a seed is, a post seed, and a mango seed, and a A1, and all that
mhm,
is a bit of an alphabet soup these days
mhm,
because I think the notion of using capital is kind of the right kind of point. Sometimes some of these industries are a little more capital intensive, others, or sales cycles are a little bit longer, so you don't
mhm,
have that feedback. But I think no, everyone doesn't forget the same triple, triple, double story that we all have loved to kind of more or less
mhm,
say as gospel in the SaaS world in doing that,
mhm,
solving for that. And so, I think that was a very long-winded answer to say it depends.
mhm,
But I think that, when we look at a lot of our portfolio, I think a lot of times the best companies will be raising ahead of their metrics. I think there's a lot of coming with a prepared mind and understanding the space and being able to understand the dynamics to believe that what the vision the founder has and kind of their approach is going to work, because I think the data will never always be there. I think in venture, one of the
mhm,
things over the last 10 years, the best companies have been able to demonstrate and really get people to believe that that's the case. There is a point in time where there's the belief and the reality of actually building a great business and drawing that merit is the case. I actually joke a lot to the founders, like, hey, I think your last round was a lot easier race because they just had to fall in love with you. I had to fall in love
mhm,
with you and the business you built. So I'm sorry
mhm,
that I have to ask a little more questions because it just can't be me and you and a coffee. And by the end of it, we'll know what that answer is because now you have a lot of data or at least something to show for your vision. And now
mhm,
I kind of have to understand, is that vision that I can take it to the finish line with you
mhm,
over time, right? And so
mhm,
that's, I think, some of the things that have to be in consideration when we think about A's and B's, because I think historically the A today was probably a B of a few years ago, right? Like, I will give
mhm,
you an interesting example. One of my first couple deals, we were thinking about the term sheet. It was like a 30 something million Series A, a couple million check, and now like at YC, the pre-money expectation is already in the 20s, right? At some shape
mhm,
or form, right? The B's before were somewhere 60 to 80, and now a good Series A, if you raise your seed at the 20s, will be 3x of that because everyone wants that nice markup, and so you're talking about a 60 pre and doing that, right? And so
mhm,
this, I think, there's just been a shift in this alphabet soup,
mhm,
and so that has kind of, but the companies sometimes raising at those prices, inflation aside, I think
mhm,
are earlier than they ever been before,
mhm.
and doing that as well too. So I don't know if that resonates, or at least sounds a lot similar to a lot of your other guests here at the show. But I feel like these I've heard it from founders oftentimes that these are the stories they're telling me when they're
Mhm.
going out for their round.
For sure. I feel like it's definitely like varies from like company to company or sector to sector. Let's say like for example, let's say using Ghost as an example. So lately I've seen other, B2B like marketplace, like I guess like inventory platforms. I wonder like in the consumer sector, especially for the SaaS company to exist, like there's so much competitions. How do you kind of like evaluate for this type of companies and like what kind of like financial benchmark or like client signal that you have to they have to have that would make you feel comfortable to making the investment?
Absolutely. I think it comes down to no matter what, regardless of stage and time, you can ask private equity investors or IPO
Mhm,
investors. It always comes back to the team,
mhm,
regardless of how good the numbers are. And Dee and Josh, the co-founders of Ghost, were those that have been in the industry for an extremely long time and been able to demonstrate and just have the connections that are needed to kind of succeed in an ultra competitive retail commerce world. I think if you think about marketplaces and kind of what there's a lot of
mhm,
network effects to be had in terms of really that cold start and kind of really cultivating
mhm,
that. And so there's a what they've done because in their prior lives have started in the space have been there so
mhm,
long is to kind of turbocharge that and frankly brute force it in order to turn it from like a few disparate transactions in order to really be a
mhm,
ball to hum and grow from what they've done, right? But at the same time, I think a lot of it is we heard this pain point at the same time a lot from um, our ecosystem. At the end of the day, we have a number of retail brands as LPs in our fund.
mhm,
Um, think of like Caring, which owns Gucci, Puma, YSL have been long-term partners of ours. To
mhm,
um, you know, to a number of others, and being able to hear and understand kind of that on a circulatory basis that people won't want to throw away their goods. How do you make that kind of disappear in a sustainable fashion? How to make sure my brand doesn't show up at TJ Maxx and Ross,
mhm,
80% off all the time, right? Because that's not, spent
mhm,
all this money to build brand equity. The last thing I want to see is my Nikes there for, 90% off, right? That
mhm,
there's a lot of that kind of problem too as well. Amongst just, there's just demand globally for these brands, and there hasn't been a
mhm,
great outlet because I think commerce or maybe retail as an industry as a whole is still from a channels perspective very regimented, and technology hasn't permeated in a way that allows you can freely buy it just like if you're buying software. And so what are things that you can do to kind of allow more outsized demand play out? And so Ghost was kind of one of those ideas that combined a lot of those kind of elements in doing that, not just have a great team, but we understand the problem really well, then an ecosystem of brands and retailers to be able to introduce them, because it's a very global problem, right? It's
mhm,
not like Nike just sells in the US, Nike sells in Europe, Asia, etc., right? And so this is something where a lot of you can transverse different borders and thinking about that. And so
mhm,
we can help them really kind of scale as they think about that over time. And so those are elements that were really important in thinking about evaluating that vision. And we've seen, companies like Affair are really large, and this growing kind of world where people sell on Whatnot or on Amazon or on Walmart, all these marketplaces where there are all these third-party sellers have to get inventory somewhere. And so there is no good place for them to do that because to build an account at I'm sure at take your favorite brand, you have to be a certain scale to do that. And these micro sellers,
mhm,
as you've seen, and as kind of being involved in a company like Zen Business, which helps kind of 20,000 plus founders kind of start companies every month. They are looking for ways to kind of access that in order to do it, and in order to build a business for themselves. And so this was kind of there was a lot of tailwinds in helping solve that. And so while I think from a metrics perspective, it was earlier at the time. I think earlier this year, L Catterton, which is owned by LVMH, was able to, hear from a lot of their brands how important a product like Ghost was in solving their needs in both sustainability as well as kind of inventory lifecycle management. And
mhm.
so kind of was fortunate enough to raise a nice large growth round for them earlier this year, only 1 year afterwards.
Mm, I wonder, so like since like you guys invest in, let's call it like Series A, Series B or after, but like what were some suggestions or like I guess like observations that you feel like you have for seed investors or like pre-seed investors? Because at your stage there's a lot of like different data benchmarks. But like, is there any common factor that you've seen that like people make it to the Series B and above kind of all share. So beyond like, the founder obviously have a lot of domain knowledge, but what would be some kind of like, I guess like overlooked benchmark that you felt like early stage investors should pay attention to?
I think historically seed funds knew that if you ran a seed fund you were looking for certain qualities, and there's this notion of a kind of like a factory line, and then you knew what they were looking for, that to get that markup for the Series A, and then you're going to pass the baton along, and it was really the Series A team can be able to do that. I think over the years, as you've seen, every fund kind of become multi-stage. A lot of our favorites known funds have gone earlier now, and also have a seed arm and be able to invest that kind of throws off the kind of economics of how to make a successful seed fund, because you need a certain type of exits in order to make the carry work, et cetera, and
Mhm,
solving for that. So that competition has kind of really shifted downstream on doing that. At the same time, there's all these, new solo GPs or spin out funds that are kind
mhm,
of going after that, because I think the network of finding these companies has just changed a little bit in terms of kind of spotting these top. What we observed is that every kind of early stage fund has one or two. If you use the same power law, there's always one or two companies every year that really kind of stand out.
mhm,
And doing that, I think if we take a step back and look at outside of the same fundamentals of the team and kind of the problem they solve, and what they do, we just seen a lot more specialist funds focused on getting and solving for that specialist problem. So I wouldn't call it that they're AI funds per se,
mhm,
but I think there's a lot of those that are engineering kind of focused GPs that were kind of high powered executives or former founders before, that really are good at solving and helping build that product side of the world. Or you have those are sector specialists that just have, a network in fintech or healthcare to kind of help doing that on that side. A lot of times that's what's missing when you kind of go into the A, is because the amount of capital raised for the company, the bar is just set a little bit higher on what you've done with that money in an efficient manner. That in itself, I think, sometimes gets lost because it's a this industry is very capital intensive, and so you have to really be able to showcase that you've been able to do what you needed to do. But at the end of the day, the guidance still is: can you set up a team, set up the infrastructure in place so that if you raise that next round, you can be able to start hitting the ground running, as opposed to kind of pushing the limits of what's able to, and then once you get the money, kind of stumble a little bit because you kind of in that now teenage phase a little bit, if you will, kind of
mhm,
figure it out, grow, and then you're like, okay, back to the races we go, right? And doing that. And sometimes I think that gets forgotten because everyone's just focused on how do I get that markup as fast as possible, because
mhm,
I need a feedback loop to showcase that my fund one is doing right, so I could go into fund two, and so et cetera, as opposed to the art of just, hey, I'm partnering with this founder for a long time, that because they've been trained at a larger fund, they're spending out and they're doing it. And you bring those same best practices, if you will, and doing that. But I think the value prop of capital, and plus that seed founder, has really changed for the founders. What I mean by
mhm,
that is you see so many large party rounds, or at least a group of investors kind of coming in, and so the founder gets to kind of build their all-star roster, if you will. You
mhm,
can help a little bit on GTM, you get to little help me on branding, you get to help me on hiring, and so everyone brings a little bit of specialness to the
mhm,
table and why they justify needing to be at the table. And so
mhm,
because they do all that, it's on the founder's job to be able to take advantage of that, outside of just saying, hey, it was nice when you told me you gave me the money and now I haven't came to collect,
mhm,
and doing that. And so I wouldn't, if I take a step back and think about your question, I don't know if there's really anything per se missing, unless the
mhm,
founder didn't take advantage of what was available there. Obviously,
mhm,
you take your favorite name brand fund, they can't do everything for you. And I think that's not the case in solving for that. But, if you're maximizing a very high valuation, you raised a bunch of money, I think everyone just expects a lot more coming out of it than not.
mhm,
You can raise on vision only for so long. And so you
mhm.
have to actually showcase that you can build something meaningful out of it.
Totally. I want to keep it with like maybe one real question and then one quick like 1 minute fire round for you. So, let's say when you're looking at the company that you have either missed that become a great company or like you have invested in, but you could invest in a different company. I wonder like what would be the core lessons there for the missing ones or like, the ones that you felt like um were gonna make it, but like, didn't end up as having the same amount of success as you predict.
Yeah, I think no matter what, either side of the coin, I think there's a lot of luck involved at the end of
Mhm,
the day.
mhm,
And I think that doesn't change no matter how quote unquote prepared you are in solving it. And so I think to answer going backwards, like what worked or what you thought should have worked but didn't work, I think there's a whole host of luck, be it the industry, market tailwinds,
mhm,
or just where you thought the team or someone would work out. It's the case, right? Just like a founder hiring their VP of sales. Sometimes that first VP of sales just may or may not work out, even though you've checked the boxes, you learn from it and do that. And so I think some of the companies that may have just, kind of stumbled a little bit more or just took a little bit longer to get out that, I think has a lot of it is you can only be so prepared in trying to inflect and doing that. Oftentimes, it still comes back to having the team ready in place to go to execute on it. And so that kind of timing versus kind of the
mhm,
team being able to ready to do that was I think a very big lesson that sometimes knowing that it's a in between round, you're getting a little bit earlier. You just have to have the patience for that growing spurt to happen. A la, then you bring in the CFO in, or they bring in a new VP of sales, or
mhm,
they have a new marketing person to build a brand. Like those things don't happen overnight, and so you're gonna that's kind of bake it into the expectations of everyone to be able to do that. And
mhm,
that may or may not happen because even if you know that expectation, that person wasn't there, and so there's a lot of experimenting going on. But the time it clicks already, right? You're burning
mhm,
money, and people expect for you to grow a certain way in order to have that momentum going. And so I think that's probably some of the things I learned that um, without that person in place or really taking really good stock into knowing that that will take longer than we think it will take. That's been
mhm,
a reason why it doesn't work. And then I think for the thing that does, like the big misses, I think a lot oftentimes are very deal specific. New team, new team's a little raw, or the market isn't
mhm,
deep enough, the valuation's too high. There's always one of those three things that we were hanging our head on that couldn't hang our head on.
mhm.
Sometimes the industry is just a little too far off than what we spend time on, but most of the case, it's really underselling what was there and just not being able to take the leap of faith. And so then you miss because of that.
For sure. I feel like it's a lot of like you mentioned, there's like a lot of luck, and then there's like so many different factors in like selecting these companies. I wanted to quickly say hi to the audience. Hi, Crispin. So I want to end with like a quick 1 minute fire round. So, what's your favorite book?
Ooh, skip. I'm not a good reader. Uh,
Uh,
I read way too much for work already, so it's been hard for me to find time to read. It's actually on one of my 2025 goals to find a favorite book to read.
oh my God.
So,
Uh, who made the biggest impact in your career?
ah, I think I've one of the people I've worked the longest with is Danny, our founder and CEO, and so I've kind of watched me grown from an associate all the way now to kind of leading the U.S. office. So given a lot of opportunity and learned. He kind of had jumped a number of firms and built it from scratch too as well, and so. Obviously, working closely with them, I've learned a lot, not just on the deal making side, but just kind of how to conduct and build something and be an entrepreneur about it.
Who would you invite to a dinner party?
Ooh, I would invite our incoming president.
Oh, wow. Where can we find you outside of work?
You can find me taking care of my new daughter, who's 6 months old right now, and I am trying every day to figure out how to find more time to spend with her when in a very demanding venture travel schedule.
Amazing. Well, Simon, thank you so much for coming on the show. It was such a fun conversation. Oh, also, audience already gave you the answer of the books that you need to read. Love this. Awesome.
Love it.
Thank you so
Awesome.
much, Simon. Appreciate you. Let me quickly end stream.